You know what's crazy right now? There are people losing sleep over their stock picks, checking their portfolio 17 times a day, convinced they're one trade away from becoming a multi-millionaire that is financially free. While Warren Buffett, the literal GOAT of investing, is sitting back saying, just buy an index fund. And yet, so many people are not listening and they continue to try and beat the market. Today, we're going to look into the facts about index funds versus individual stocks. Which one actually makes you wealthy? Why do 9 out of 10 stock pickers fail? And should you even be picking stocks in the first place? Here's what happens when most people start their investing journey. They imagine buying Tesla at $30, Amazon before it blew up, and Nvidia before AI went mainstream. One perfect pick, early retirement, big house, luxury, vacations. That's the fantasy. But here's the reality. Most investors, and I do mean most, end up with portfolios that look like a yard sale after a tornado. There's some winners and a lot of losers, and returns that don't even come close to the market average. But why? To understand what is going on, let's first cover the basics. First up, what are index funds? Think of an index fund like this. It is like buying a tiny slice of the entire market. You buy something like the S&P 500 and boom, you instantly own pieces of 500 of the top companies in the US. Companies like Apple, Microsoft, Amazon, Tesla, Coca-Cola, Disney, and the list goes on. There's no researching, no guessing, no 2 a.m. YouTube rabbit holes trying to figure out if some CEO's tweet means you should buy or sell. Index funds are designed to match the market, not beat it. That is a good thing because it provides returns you can count on over the long run. Now, individual stocks, they're exciting, I get it. The appeal is obvious. You get control, you're the one making the calls, you can invest in companies you actually believe in. You might hit that 10x return everyone dreams about. It feels smarter than just buying everything. But individual stock picking comes with a brutal reality. You're not just taking on more risk, you're taking on concentrated risk. One bad earnings report, one scandal, one market shift, and your portfolio can get crushed. It demands constant attention. You need to read earning reports, track industry trends, monitor news, understand balance sheets. It's a part-time job. And here's the big one. The odds of success are much lower than anyone wants to admit. Okay, pay attention to this part because this one number might change your entire investing philosophy. According to the S&P Global SPIVA Report, which tracks professional money managers, 85% of professional portfolio managers fail to beat the market over a 10-year period. These are people who do this full time, have research teams, have Bloomberg terminals, they went to Harvard, and they manage billions of dollars. And 85% of them lose to a simple index fund. And if we increase that time period to 15 years, that number jumps to 90%, which means only 1 in 10 pros can consistently beat the market over a long period of time. So let me ask you this. If the experts with every advantage imaginable only beat the market 10% of the time, do you think it is worth it for you to try? So why is it so hard to beat the market? Here are 2 of the biggest reasons that I found. The first one is human emotions tend to wreck everything. We have FOMO. We buy stocks when they're hyped up and at all-time highs, and then we panic sell when they drop. In this scenario, we are buying high and selling low, which is the opposite of what we should be doing. And number 2, trying to predict the short-term ups and downs of the market is notoriously difficult, even for professionals. Missing even a few of the market's best performing days can significantly reduce long-term returns. One study showed missing just the 10 best days over a 20-year period would drop your yearly returns from 9.7% down to 5.5%, which is a huge difference. There was also a study done by Professor Hendrik Bessembeiner from Arizona State, and he found that only 4% of individual stocks account for all of the net gains in the US stock market. The translation here is that most stocks just underperform. Many don't even beat treasury bills over time. The entire stock market's success depends on a tiny handful of mega winners. And here's the beautiful part about index funds. You are guaranteed to own those winners. You don't have to guess, you don't have to get lucky, you just own everything and the winners carry you to long-term growth. All right, decision time. If you want low stress, reliable long-term returns, minimal time commitment, the highest possibility of success, then index funds are the pick. But if you love researching companies, understand valuations and balance sheets, can handle wild swings without panicking, and have real discipline, then allocating a small portion of your portfolio to individual stocks could be for you. Here's what a lot of smart investors do. They have a core, stable investment plus some fun/high-risk investments. For me personally, I like to have somewhere around 95% of my core stable investment in index funds, and then about 5% in a high-risk investment like individual stocks, just for fun. This is money I don't mind if it goes to zero. Structuring my portfolio this way, I am protected by the market, but I can still scratch that investment itch. Let's bring it back to the Oracle of Omaha, Warren Buffett, who built a $100+ billion fortune picking individual stocks, and he has repeatedly said, a low-cost S&P 500 index fund is the most sensible investment for most people. And get this, he instructed that when he dies, 90% of his wife's inheritance should be invested in an S&P 500 index fund, and the other 10% in short-term government bonds. Not Berkshire Hathaway stock, not a hand-picked portfolio, just a simple index fund. If the greatest investor alive trusts index funds with his family's wealth, maybe we should listen. Building wealth isn't about being brilliant. It's about being consistent. Index funds don't require us to be a genius. They don't require perfect timing. They don't require luck. Just time and patience, which is really hard in today's world of instant gratification. Individual stocks can be fun, they can be rewarding, but statistically, most people are just better off owning the market instead of trying to beat it. That is why I personally just continue to invest in index funds that track the market and let time and compound interest just do its thing. What are your thoughts? Are you team index fund or team individual stock? Drop a comment and let me know your strategy. And if this video helped you see things differently, tap that like button, subscribe, and I will see you in the next one.